If your last R&D tax claim was for a period starting before April 2024, the rules have changed under you. The SME scheme and the RDEC scheme, which used to run side by side, have been replaced by a single system, the merged scheme. For any accounting period beginning on or after the 1st of April 2024, the merged scheme applies to every company making a claim, regardless of size. There's no opting into the old schemes, even if they have worked out better for you before. The only exception is the Enhanced R&D Intensive Support Scheme, or ERIS, which stays available for certain loss-making SMEs. The headline rate is 20% of your qualifying R&D expenditure, paid out as an above-the-line credit. But because that credit counts as taxable income, what you actually keep depends on your corporation tax rate. Work it through, and companies paying the small profits rate of 19% get a net benefit of 16.2%. Companies at the main rate of 25% get 15%. Unfortunately, that's lower than the old SME scheme offered. There's also some changes to the qualifying costs of the scheme. First, subcontractors. Under the old RDEC scheme, large companies simply couldn't claim for subcontracted R&D costs at all. That restriction is now gone. Everyone can claim 65% of qualifying subcontracted costs. But there's a catch. The company claiming has to have genuinely intended or contemplated the R&D before the work began, and that needs to have been documented in writing at the point where you engage the contractor. HMRC introduced this specifically to stop both sides of a contract claiming for the same work. Second, overseas expenditure. Under the merge scheme, R&D has to happen physically in the UK to qualify. Nationality and where the company is registered don't matter, only where the work is actually done. There's a narrow exception if the conditions you need genuinely don't exist in the UK, like studying a disease that isn't present here or using specialist equipment that's not available domestically. Lower cost overseas is just never a valid reason. Here's a quick worked example. A company spends £500,000 on qualifying R&D in an accounting period starting June 2024, paying corporation tax of 25%. The expenditure credit is £100,000, 20% of the spend. After tax on that credit, the net benefit lands at £75,000, or 15% of the original spend. If you're a loss-making SME spending at least 30% of your total expenditure on qualifying R&D, it's worth checking whether ERIS suits you better. It follows the structure of the old SME scheme more closely, an additional 86% deduction on top of the standard 100%, then a payable credit at 14.5% of the resulting loss. The real-world benefit works out at nearly 27%, considerably higher than the merge scheme rate. Two forms are also now mandatory across the board. The advanced notification form, if it's your first claim or you haven't claimed in the last 3 years, which is due within 6 months of your accounting period ending, and the additional information form, which is required for every claim since August 2023. If you're preparing your first claim under the merge scheme, pay particular attention to the overseas restriction and the new subcontracting rules. They're the two areas most likely to catch established claimants out.